Namaste everyone and welcome to the lecture 3 of Fundamental Analysis of Companies. And in this lecture, we will be learning the balance sheet. We have already completed profit and loss statement in the lecture 2. And after learning the balance sheet, which is also known as the assets and liability sheet, we will be proceeding to the next of the topics which are shown on your screen. So let's proceed. So let's understand the first item in the balance sheet, which is known as the shareholders fund. And it is divided into two parts. The first part is your share capital and the second part is your reserves and surplus. So the share capital, what it basically means is whatever are the issued shares. Now, in order to understand the issued shares, what it basically means is, suppose I'm starting a company and I want a company with the authorized capital of 5 lakh rupees. Now, authorized capital means the total capital that I want my company to be have. So out of those 5 lakh, now it's my choice. I can decide that a share could be of 100 rupees, 1000 rupees, 10 rupees, 1 rupees. Out of that, I decided, let's say my share, each share is of 1 rupees. So the total shares which I will get is 5 lakh divided by 1, which is 5 lakh shares. But right now I only have 1 lakh rupees and that is good enough to start my business. So I give that 1 lakh rupees to my company and take 1 lakh shares. 1 lakh into 1 rupees per share will give me 1 lakh. Now these 1 lakh are the issued shares. Okay. Now when you multiply these issued shares with the face value, now face value is already decided. By the way, you can change it in the future, but right now it is decided at 1 rupees per share. So your share capital becomes 1 lakh. 1 lakh shares into 1 as the face value is equal to your share capital. So always remember, share capital is issued shares multiplied by the face value. Now you can even change your authorized shares in the future. And how would it impact it? Just think about it. Now if you change your number of shares from 5 lakh to 10 lakh, basically that would means that the number of shares have increased. So with 1 lakh share, previously you hold 20% of your company, right? Total was 5 lakh and you hold 1 lakh. So 1 lakh divided by 5 lakh is 20%. Now if you increase your authorized shares to 10 lakh, your stake in the company would be reduced to 10%. So that's why increasing the authorized shares dilutes the promoter shares, but it actually benefits also. Now you are buying it at a face value, but when it goes in the market, the value might be high. And in order to raise money, people do increase their authorized shares so that they can increase their issued shares and they can raise money. By the way, that doesn't mean the share capital is going to be at the market price. Always remember, share capital is always at the face value, which is 1 rupees in our example. Now what about the remaining price? I mean, my face value was 1 rupees, but my share is trading at 100 rupees. What about my 99 rupees? Where will I put it? So that amount which you get is actually at a premium, and that is put into reserves and surplus. Now there are various things which comes into reserves and surplus. The first is your share premium, which you already know. The second is your trade receivable. Now suppose I have given some item or some goods for sale, but I have still not received the money. That is my trades receivable. Third is my retained earnings. Suppose last year I have a profit of 1 crore and I didn't spend it anywhere because maybe the market was too high. So that 1 crore I have still retained. So that also goes into my reserves and surplus. The next is your capital reserves. I also keep some money for the bad times. Like every one of us keeps some money in the FDs or as cash in the home. So that comes as your capital reserves. And you also have your revaluation of your assets. Now an asset which your company might have bought 20 years back, say a land, was only costs you 1 lakh rupees, but right now its value might be in 1 crores. So that revaluation, if you revaluate it, that goes into reserves and surplus. Let's proceed to the next part. So the main essence of balance sheet is about balance. The balance between liabilities and the assets. So what is liability? Liability is anything which you have to pay back, something that you owe. Okay. Now it can be defined further into two terminologies. The first could be your current liability and the second could be your non-current liability. Current liability means you have to pay it currently, and in financial terms, we means within a year. While non-current liability, you have to pay back in long terms like 3 years, 5 years, depending on the tenure and the agreement. Now you have to understand that the short-term borrowings could be, say, a 1-year loan or a friendly loan from a family member, while the trades payable is something which you have bought on credits. Now in corporates, credit works a lot. You buy things, and when you sell it, then you pay back the money for the goods that you have bought. So these are the trades which you have to pay. And generally trades payable are short term, but they can be long term also. So it really depends how we have borrowed it. Okay. And the second is a long-term borrowings, like long-term bonds borrowings or whatever it is. And you also have deferred tax. So if I don't have the money to pay the tax, or if for some of the reasons that there are a lot of interesting reasons, I don't want to pay the tax right now, so I can defer it. Okay, so that goes into my long-term liabilities. Now, apart from liabilities, the second option is assets. Now, asset is something that you own. Okay, it could be land, it could be machinery, it could be cash, it could be bonds, and a lot of other things. So assets are also broken down into current assets and non-current assets. So current assets is something which can be converted into cash or cash equivalents within a year. Now, why do we say cash and cash equivalents? We don't say a company has cash. Okay, they really don't just keep all the money in a bank or in a locker. They have cash or cash equivalent. Cash equivalent would be something which is liquidable, which can be quickly converted into an asset. Okay, so the current assets, some of the examples are inventories. Inventory is something which you have created and you want to sell it, or that's under the sell. You are going to sell it eventually. The second is trade receivable. So the way you have trades payable, people also buy from you on credit. Okay, and this is where your cash flow will come into account later. So trades receivable is something the person has already taken goods from you and still has not paid you the money back. Does this reminds you something? Okay. And the third is your cash bank balance. So you might have a cash or you might have a bank balance that goes into current assets. And last is your loans given. Now, as an entity or even as a person, you can also give short-term loans, right? Now, the non-current assets are tangible assets. If you remember what is tangible, it means something that you can touch, like lands, machineries, and then you have intangible assets, which will basically your patents, your goodwill. A company's goodwill is also actually quantifiable to an asset, right? Now, you also have capital work in progress. Now, suppose I'm making a car, and currently in my production line, there are 20 cars which are under progress. So they are neither inventory, okay, nor they are raw materials. So they are my current work in progress, and that is called capital work in progress. Okay. Now the last would be long-term loan given. I can also give long-term loans, so that would be non-current assets. So the main thing you have to understand is that your assets is equal to your liabilities plus shareholders fund. Now you might be wondering, shareholders fund, why is it in liability? It's an asset, right? So what has been seen is consider a company as a separate entity, and for that entity, whatever the reserves and surplus and share capital is, it doesn't belongs to it, right? It is basically something it had borrowed from the promoters. So that's why it goes into the liability. Now this balance sheet is equally important because if you make any calculation mistake or your CA makes any calculation mistake, that might reflect here because your assets and liabilities columns plus shareholders fund has to balance. Okay, so now let's take an example and go to our website and see how to analyze these. So we have again went to the screener.in, and here I have typed down Tata Chemicals, and I've clicked here on the balance sheet to get the balance sheet of Tata Chemicals. Now just don't look around and get confused, just stay with me. So the balance sheet will have three major sections. One is going to be your shareholders fund, the second is going to be your liabilities, and the third is going to be your assets. Now in the shareholder funds, what we have learned is we have a share capital and we have reserves and surplus. So this is a share capital, and Tata Chemical has not increased its share capital for the last 10 years. That means your valuation has not diluted further. And then you have your reserves and surplus. So you can see the reserves and surplus are increasing. But keep one thing in mind. Suppose I am selling car for 10 lakh rupees, and out of that 9 lakh is trades receivable. That means I have sold it on credit. I have still not received the amount, and I have borrowed 4 lakh rupees to sell it for 10 lakh rupees. Now how am I going to pay the loan back? So a high reserves and surplus has to follow with a high cash flow, free cash flow. Okay, we'll be learning it in the next lecture. But yeah, so a high reserves and surplus is a good thing, but it has to follow with a net cash flow. Okay. The third thing which we are seeing here is your borrowings. Now you might have seen that we have bifurcated it into current liabilities and non-current liabilities. And some of the websites like moneycontrol.com, you would find that bifurcation even in the balance sheet. But screener.in doesn't bifurcates it that way, but that's going to be completely okay. Let me tell you the reason. So the reason why we are here is that we wanted to learn the fundamentals from the balance sheet. I would not really ask you to go through all these numbers and calculate the percentage increase. No, never. We are going to use the power of mathematics in the financial ratios, and you will know all of these things within seconds. Without calculating anything, they would be there on the website. I mean, if you can calculate and the computer can calculate, then let's just show the calculated results, right? I mean, I trust you guys, you can do it yourself. So let's go to the borrowings. So borrowings has your long-term borrowings, which is basically your non-current liabilities, and it has your short-term borrowings, which is your current liabilities. So you can see that its long-term borrowings have kind of increased, not a lot. Okay, and short-term borrowings kind of decreased. It's only 543 crores. That's pretty good reduction. Okay, but it depends. I mean, I can't just infer it without referring to the annual statement that why it borrowed large money in the past. Maybe it wanted to expand, and now since it has expanded, it has it's controlling its expenses. So that's okay. Yeah. And then you have your lease liability, other borrowings. If you really wanted to understand what are these other borrowings, which was in 2021 6,900 crores, you really have to go to the financial annual report and look through it. Now if I just minimize my borrowings and if I go to my other liabilities, so what I am seeing here is that I have my non-controlling interest, I have my trade payables, you know, I have to pay these money, so these goes into my current liabilities. Now it depends. Generally the trade receipt payables are within a year, but there are instances where the trade payables can be for few years. Then it would go into non-current liabilities. And I think that's the reason that this website doesn't list into current and non-current. Otherwise it has to really go into the financial statement, separate whether it is a current liability or a non-current liability, and the chances of error increases. Then it has the advances from customers and it has other liability items. So based on it, you are going to get your total liability, which is approximately, so this is your recent data on the right hand side. So on some of the website, you will find it on the left hand side, but yeah, it depends how it is made. So you don't really have to worry. And then you have to go to your fixed assets. Now we are going to our assets. Okay. Now the fixed assets, let's click on the plus sign. You see all of these things: land, building, plant and machineries. These all are your tangible assets, right? And these goes into your non-current assets. So what we are seeing is, I mean, you can basically see here that how much is the value of the land. It's almost remained same. Maybe they increased here a bit, but yeah, Tata Chemical is not buying lands. But let's see if it's buying buildings or if it is buying more machineries. It is buying more, no doubt. And then basically you can just look through all of these columns and try to infer something. Now the reason why we are looking at this is right now it's okay, but if there is a sudden jump in some of the numbers which doesn't make any sense, that's a flag thing. Okay, that's why we have these things. Now you have intangible assets at 2,000 crores. You have to go to the annual report and look. No, when I say you have to go to the annual report, you really don't have to just switch quickly. The reason is when you're investing in a company, you invest based on different sets of rules. The first rule is if you're investing a little amount of money, just going to this website or any other website and looking at the fundamentals and proceeding with it would be definitely okay. But if you are investing a large chunk of money at a regular period, then you really have to go to the annual report and see what is this goodwill of 2000 crores. Okay, this could be, what is this intangible assets? I mean, is it patent or is it just the goodwill? Because if the company makes any corruption, the goodwill value can go down. So you really have to understand what are those assets. Okay, and the good thing about land is that you see the land value has remained same. Now this is something which a lot of companies you might have seen, that they have a lot of land, especially the companies which are capital intensives in terms of say port, say Adani ports, and they have a lot of land and a lot of strategic port location. The values in the balance sheet might not reflect the actual values. The actual values could be 100 or 1000 times higher. That doesn't mean go and rush it. Okay, you have to really think. I mean, it is possible that they have adjusted it in the reserves and surplus. As you know, reserves and surplus, they can adjust their assets value and increment in the assets value. So you have to see whether they have adjusted or not. Okay. So after going through the fixed assets, we have GWIP. So yeah, CWIP. This is basically capital work in progress. I hope you remember what it is. And then you have some investments, and then you have some other assets which are your inventories. Now if your inventories are increasing, that could mean two things. First is the sales are decreasing, so the inventories pile up. The second is because of the increase in sales, the company is increasing its revenues to meet up the sales. Okay, so you have to look at the sales figure, which in Tata Chemicals it's increasing. And then you have your trades receivable. Now this is an important part. I mean, if your trade receivables is way high, like from 1300 crores to 2600 crores, almost doubled, that means the people have taken item from you and have not paid you back. And if this increases too much as compared to the net profit or the net current liabilities, that's where the problem comes in. But you really don't have to just go up and see the current liability and just compare it with this. You don't have to do it. We will do it within a fraction of seconds using financial ratios, where we will know whether the company is in a situation to pay back its current liabilities or not. Okay, we will be learning it later in the financial ratios. Then you have your cash equivalents, your loan and advances, and your other assets. One thing you might have noticed is that your total assets is equal to your total liabilities. You just have to note it. There is like, I think, zero probability, I would say, that this could be wrong. Okay, so this is whole of about your balance sheet, and you don't really have to juggle through all the numbers, but you can once in a while look through one of these and try to make inference. This is called critical thinking. Try to make inference. Okay, this is the land, and is it on a historical value or is it on the current value? Okay, it's in a historical value of 20 years old. The current price is 100 times X. So then the intrinsic value will become this much. And yeah, this is how you will in future try to analyze it in more deeply. So that's all for lecture 3, balance sheet, and I hope you guys have learned something again. And please feel to share your comments or feedbacks on the above given email ID, and see you in the next lecture.